The question is not whether The Economist has suddenly turned into a crystal ball, but why so many readers in the United States are now primed to read its pages as if it has. For more than a century, the magazine has played a familiar role in American life, not as a fortune teller, but as a polished mirror held up to the thinking of policymakers, investors, and institutional elites. When people ask whether it predicted the year 2026 as a moment of collapse, they are really asking something more revealing. Does the mood of the people who run the system suggest that the system itself feels fragile? The Economist almost never speaks in the language of apocalypse. It does not issue countdown clocks or declare final deadlines. Instead, it relies on symbolism, framing, and tone. Covers are crowded with visual metaphors. Articles lean on conditional language. Risks are arranged like chess pieces, rather than shouted like fire alarms. Yet that restraint is precisely what gives the magazine its power. When it grows darker, when optimism is replaced with hedged confidence and contingency planning, readers notice. In the United States, especially after years defined by pandemic, inflation, political turmoil, and war abroad, those tonal shifts now land differently. They feel less like abstract analysis and more like warning signs. The original article at the center of this debate does not claim that 2026 will be the year the global economy collapses. It does something subtler and, arguably, more unsettling. It lays out a world in which stress is no longer an exception but a baseline. Governments are stretched, debt is normalized, voters are exhausted, markets function, but without much margin for error. The suggestion is not that disaster is inevitable, but that resilience has been quietly depleted. In that context, collapse does not need to arrive as a single dramatic event. It can show up as a series of small failures that stop being temporary. For an American audience, this framing hits close to home. The United States has spent decades assuming that shocks are survivable by default. Recessions are followed by recoveries. Political crises burn hot and then fade. Even the global financial crisis and the pandemic ultimately reinforced a belief that the system bends but does not break. What has changed is not the presence of risk, but the accumulation of it. When every institution is already operating under strain, the next shock does not have to be historic to be dangerous. The Economist's real message, then, is not a prophecy. It is a diagnosis of mood among those who usually sound calmest. And when the people paid to think in long-time horizons begin to hedge their language, it tells us something important about the moment we are in. Not that collapse is scheduled, but that confidence is no longer cheap, automatic, or widely shared. 2026 arrives with a symbolism that is impossible to ignore in the United States. It marks the 250th anniversary of American independence, a milestone usually reserved for triumphal speeches, fireworks, and carefully edited national memory. Yet the mood surrounding that date looks far less celebratory than planners once imagined. Instead of a confident superpower taking a victory lap, the country approaches this anniversary in a state of visible tension, arguing over its past while doubting its future. The original article frames this contrast deliberately. On one side stands the mythology of American continuity, the idea that the Republic has survived civil war, depression, world wars, and social upheaval, and therefore will survive whatever comes next. On the other side stands a far less romantic reality. Political polarization has hardened into identity. Trust in institutions has eroded across parties. Elections are no longer treated as routine civic rituals, but as existential battles. The question is no longer whether Americans disagree, but whether they still agree on the rules that govern disagreement. This matters because anniversaries expose stress rather than conceal it. A 250th birthday is not just a celebration, it is a stress test. It forces the country to ask what, exactly, it is honoring. In the past, national milestones reinforced cohesion. Today, they risk amplifying division. Even the act of commemorating history has become contested, with narratives competing instead of converging. The article does not suggest that the United States is on the brink of collapse in the traditional sense, but it does point to something more corrosive, a shared story that no longer functions. Recent data reinforces this unease. Surveys conducted in late 2025 show public trust in Congress, major media outlets, and even the electoral process hovering near historic lows, while partisan hostility remains elevated. Analysts warn that this level of distrust does not need a dramatic trigger to become destabilizing. It simply reduces the system's ability to absorb shocks. The danger, as the article implies, is not a single breaking point in 2026, but the accumulation of unresolved tensions converging around a symbolic year. When celebration collides with cynicism, the result is not fireworks but friction. And in a political environment already defined by zero-sum thinking, friction has a way of spreading. 2026, then, becomes less about whether the nation still exists and more about how it functions. A country can endure on paper while losing confidence in itself. That is the quieter risk embedded in the anniversary, and the one the article urges readers not to dismiss. Beyond American politics, the article widens its lens to the global economy, where the tone shifts from anxious to fatigued. The defining feature of the current moment is not collapse, but exhaustion. Growth still exists, but it limps rather than runs. Inflation has cooled from its peak, but prices remain elevated enough to strain households. Debt has stopped being a red flag and started being background noise. The system continues to move forward, but with the posture of something carrying too much weight. The core argument in the original piece is that the world economy has entered a prolonged period of low-margin stability. For years, policymakers relied on cheap money, expanding credit, and globalized supply chains to smooth over structural weaknesses. That playbook no longer works as cleanly. Interest rates are higher, fiscal space is narrower. Geopolitical risk is persistent rather than episodic. The result is an economy that can still grow, but only if nothing goes wrong, and history suggests something always does. Recent global forecasts underline this vulnerability. Updated projections for 2026 point to worldwide growth hovering just above 3%, with advanced economies trailing behind that average. Manufacturing output in parts of Europe continues to contract, while Asia shows pockets of resilience driven by exports and industrial demand. The headline numbers suggest stability, but the distribution tells a less comforting story of divergence and fragility. In the United States, the picture is equally uneven. The economy has avoided a deep recession, but it has not regained the momentum that once defined post-crisis recoveries. Job growth has slowed. Consumers remain cautious. Wage gains are real but uneven, often offset by higher costs of housing, insurance, and debt servicing. This is not a collapse scenario. It is something more ambiguous, and arguably more dangerous. Stagnation that feels permanent. The article is careful not to oversell disaster. Instead, it highlights how prolonged weakness reshapes behavior. When growth is scarce, politics hardens. When opportunity narrows, tolerance declines. Economic systems do not fail only because of numbers on a chart, but because people stop believing that tomorrow will be better than today. That belief has quietly eroded across much of the developed world. Analysts now warn that the greatest risk is not a sudden crash, but a slow grind in which governments rely on deficit spending to sustain demand, while hoping productivity gains eventually arrive. This strategy can buy time, but it also accumulates pressure. With global debt levels already near historic highs relative to output, the room for error continues to shrink. The global economy, as portrayed in the article, resembles a bridge under constant traffic and deferred maintenance. It has not collapsed, but every additional load matters more than it used to. 2026 does not need to deliver a shock to expose that reality. It only needs to arrive without relief. If there is a place where abstract stress turns into measurable risk, it is the bond market. The article treats this not as a footnote, but as a quiet fault line running beneath the global economy. Equity markets grab headlines, but sovereign debt is where confidence in governments is priced every single day. And in recent years, that pricing has become far less forgiving. The shift began when central banks moved aggressively to tame inflation. Higher interest rates were necessary, but they came with consequences that were easy to ignore while growth held up. Governments accustomed to borrowing cheaply suddenly faced rising debt servicing costs. Deficits that once seemed manageable started to compound faster. What looked sustainable at near zero rates looks far more fragile when refinancing occurs at 4 or 5%. The article does not frame this as an imminent crisis, but as a structural squeeze that tightens year after year. In the United States, this pressure is especially pronounced. Treasury markets remain deep and liquid, but the scale of issuance has grown enormous. Investors are being asked to absorb trillions of dollars in new debt, while also demanding higher yields to compensate for inflation risk and political dysfunction. The assumption that global demand for US debt is limitless has not failed, but it has been tested more often and more visibly. Recent financial stability assessments warn that asset valuations across markets remain stretched relative to underlying growth, while non-bank financial institutions now play a larger role in absorbing government debt. That shift matters because these institutions can be far more sensitive to liquidity stress, increasing the risk that volatility spreads faster when conditions tighten. This is not a prediction of collapse, but it is a reminder that the system relies on confidence that can move quickly. The article's tone here turns subtly ironic. Markets are described as calm not because risks have disappeared, but because they have been normalized. Investors have learned to coexist with uncertainty, pricing it in while assuming policymakers will step in if conditions deteriorate too far. That assumption has worked repeatedly over the past 2 decades, which is precisely why it has become dangerous. The more often rescue is expected, the more leverage builds in the background. Bond markets, unlike political debates, do not care about narratives. They respond to arithmetic. As interest costs rise, trade-offs become unavoidable. Spending choices harden. Fiscal flexibility narrows. None of this triggers an immediate collapse, but it steadily erodes the margin that once made shocks survivable. 2026, as the article suggests, does not need to deliver a dramatic rupture in sovereign debt markets. It only needs to arrive in a world where borrowing is expensive, patience is thin, and confidence is assumed rather than earned. In that environment, even small surprises can travel far. Economic strain rarely travels alone. It moves alongside politics, borders, and power. And the article makes clear that 2026 sits inside a world that is far more fragmented than the one Americans grew up taking for granted. The post-Cold War assumption that trade, capital, and technology would naturally flow toward efficiency has been replaced by something messier. Security now competes with cost. Resilience competes with speed. And every major economy is quietly accepting that global integration has limits. The article traces this shift through geopolitics rather than ideology. The United States is no longer operating in a system it largely designed and enforced. Strategic competition with China has hardened into a long-term condition rather than a temporary dispute. Russia remains a destabilizing force across energy, food, and security markets. Regional conflicts no longer feel isolated because supply chains are thinner and buffers are smaller. What once looked like external shocks now behave like recurring stressors. For American readers, the most tangible impact shows up in supply chains. Companies spent decades optimizing for cost, assuming that geopolitical stability was a given. That assumption has been withdrawn. Manufacturing is being reshored or friendshored at higher expense. Redundancy is being added deliberately. Inventories are larger. All of this improves resilience on paper, but it also raises prices and lowers efficiency. The article does not argue that this shift is wrong. It argues that it is expensive and that the bill arrives gradually. Recent trade data reinforces this trend. New barriers, industrial subsidies, and targeted tariffs have multiplied across major economies, while global trade growth remains subdued compared to pre-pandemic norms. Export-driven regions in Asia continue to perform better than Europe, but even there, growth increasingly depends on policy support rather than organic demand. The global system is still moving goods, but it is doing so with more friction and less trust. The article's sharpest observation is that fragmentation does not feel like collapse in real time. It feels like inconvenience, delays, higher costs, fewer choices. Over time, those inconveniences reshape politics. Voters blame governments. Governments blame rivals. Businesses hedge instead of invest. Growth slows not because of a single failure, but because coordination becomes harder everywhere at once. 2026 enters this landscape not as a trigger, but as a checkpoint. The world has already accepted a less cooperative baseline. The question is whether it can sustain that reality without slipping into open conflict or economic paralysis. The article offers no easy answer, only a reminder that fragmentation, once normalized, has a habit of feeding on itself. Technology is supposed to be the release valve. When growth slows and demographics turn hostile, innovation is meant to step in and do what policy cannot. In the article, Artificial intelligence occupies that familiar role, promoted as both savior and stress test for the global economy, heading into 2026. The promise is enormous. The results, so far, are more ambiguous. On paper, AI looks like the kind of productivity breakthrough economists dream about. Faster decision-making, lower labor costs, entire categories of work augmented or automated. Markets have responded accordingly. A narrow group of technology firms now carries an outsized share of investor optimism, pushing valuations higher, even as broader economic indicators soften. The article does not deny that this technology is real or transformative. It questions the timeline and the distribution of benefits. The problem is not hype alone, but concentration. Productivity gains, where they exist, are uneven. Large firms with capital and data scale capture most of the upside. Smaller businesses face rising costs without comparable efficiency gains. Workers hear promises of opportunity but see anxiety in their own industries. This gap between expectation and lived experience matters. Economic optimism does not travel well when it pools at the top. Recent market analysis highlights this imbalance. A small cluster of technology companies now accounts for a historically large share of stock market gains, while investment outside that sector remains cautious. Analysts warn that such concentration leaves markets vulnerable to sentiment shifts, especially if earnings fail to justify long-term assumptions about rapid productivity growth. In other words, the future is being priced aggressively before it has fully arrived. The article also hints at a deeper irony. The more policymakers and investors lean on AI as a solution, the more pressure builds for it to deliver quickly. But productivity revolutions rarely arrive on demand. They diffuse slowly, reshaping workflows, skills, and institutions over time. In the interim, societies must manage disruption without the growth dividend they were promised. For Americans, this creates a familiar tension. The country leads in technological innovation, yet struggles to translate that edge into broadly shared prosperity. 2026 may showcase extraordinary tools, but tools alone do not stabilize an economy. They require trust, adaptation, and time. The article suggests that betting on technology to offset structural strain is less a plan than a hope, and hope, as history shows, is not a strategy. By the time the article reaches its conclusion, the word collapse has quietly lost its drama. What remains is something more unsettling and far more plausible. Endurance under strain. 2026 is not presented as an end date, but as a moment when multiple pressures converge and test how much slack is left in the system. Politics, debt, geopolitics, technology, and social trust all intersect in ways that leave little room for complacency. Nothing has to break spectacularly for conditions to worsen. They only have to persist. The article pushes back against the idea of an overnight meltdown. History, especially American history, argues against it. The United States has absorbed shocks before, often emerging altered but intact. Institutions adapt. Markets reprice. Policies shift, sometimes clumsily, sometimes effectively. What makes the current moment different is not the presence of risk, but its density. Too many problems are being managed simultaneously, each one assuming that the others remain contained. This is where the tone becomes unmistakably sober rather than alarmist. The warning embedded in the analysis is not that 2026 will mark a sudden fall, but that it may expose how thin the margin for error has become. A system built on confidence can tolerate surprises when trust is high and balance sheets are flexible. When confidence is conditional and balance sheets are stretched, even small disruptions carry outsized consequences. Recent forecasts reinforce this restrained pessimism. Growth projections for 2026 remain positive but modest, signaling neither collapse nor renewal. Debt levels stay elevated. Financial risks remain manageable, but only with continued policy support. In other words, stability is achievable, but it is no longer effortless. The era of automatic recovery appears to be over. The article ultimately reframes the question Americans keep asking. It is not whether the economy will collapse, but whether it can continue operating under permanent pressure without eroding public trust, political legitimacy, and social cohesion. 2026 becomes a mirror rather than a deadline, reflecting the choices already made and the trade-offs still being postponed. The future, as the piece makes clear, is unlikely to arrive as a clean break. It will arrive as a series of adjustments, compromises, and recalibrations, some successful, others costly. Collapse is not the most likely outcome. Fatigue is, and fatigue, left unaddressed, has a way of reshaping nations just as profoundly as any crisis. Thank you for watching, and before you go, what do you think about this outlook for 2026? Is the concern overblown, or are the warning signs real? Let us know your thoughts in the comments.